These guys are the kind of the punchline around the Fed these days is, what happens to these young people who have never seen a tightening cycle. The last time the Fed tightened was from 2004 to 2006. They went from 1% to 5.25%, but they did it in 16 quarter-point moves, regular as a metronome. Now they're telling us they're going to be uncertain, without a predictable pattern. So you have people who have never done this and who don't know what the Fed's going to do next. We saw what happened with the taper tantrum. There's some concern that we might see that repeat.
Kevin, is the lack of experience, is it a plus or a minus?
You know, I actually don't even think whether you have 5 years or 15 years really matters. What really matters is we're in an unprecedented time in history, right, across the globe where rates are quantitative easing policies. So what's really happened is everyone got their training wheels taken off in 2013 when the taper tantrum originally happened, and the Fed didn't do anything. It was only verbal. And we saw rates rise 100 basis points. So I think a lot of people are understanding liquidity is the key, and that's the big issue going into that. I mean, we saw a flash crash October 15th of last year, and so one of the deepest, most liquid markets came to its knees. So we're going to have to see what plays out. IMF has warned about it, but I think it's on the back of their minds with liquidity and regulation.
Michael, when you have a scenario like this, because they're calling it the class of 2009, and the average age on Wall Street of these traders is what, about 29, 30 years old right now. They really do not have the experience. Is this a paradigm shift for them? Do they go to the old guard and say, hey guys, what was it like back in the 90s when you had a little back in the old days?
Well, there's not a lot of those old guys around, of course, because the banks got rid of a lot of experienced traders when they were trying to save money. It's not even just the age of people. It's the fact that we've been so long in a zero rate that the trade has become so easy to make. It's all one direction. The question is, when you get some volatility, some risk introduced on both ends of the spectrum, what do you do? Do people get out too quickly? Do they try to move too fast? That becomes a much more of a fundamental question when you're trying to analyze the trades.
And when everybody goes to the door at the same time, what's really going to happen? And like I said, we did get to see a slight bent to that in 2013, but technology has completely changed, and that's why the new guard, as we're alluding to, certainly has the tools at their disposal. We've seen Dodd-Frank be implemented. We've seen leverage come out of the system. So the banks should be prepared for this. It's really the non-bank sector that should be concerned. Okay,
Kevin, you mentioned new guard versus old guard. In some instances, the technology, the high-frequency trading and such, does that mean that the young guard doesn't want to roll up its sleeves and look at those graphs, look at those charts, look at those spreadsheets?
I think what they'll do is they'll actually look at that, but there's a lot of risk systems out there, and actually they'll rely on the old guard, the specialists that are down on the floor, right? So whichever specialists are less. But that's left. But you're seeing that, and like I said, back to the regulatory environment, you're seeing risk has been taken down. I mean, if you look at Dodd-Frank, I mean, the bill dwarfs Glass-Steagall, right? And everybody's been very conscientious since 2009. So ever since 2009, leverage has come down. I think the new guard is ready, and they have the technology at their fingertips to actually diversify and hedge themselves, because it has been a macro trade.
Yeah, but it's not just the traders. It's the quants. It's the mathematical geniuses out there at these high-frequency trading firms and the people who use algorithms to trade, because are their algorithms going to be able to capture, without experience now, the nuances of a new world of economics and Fed policy? And so much trading, particularly in the equity markets, is done now automatically and by machines that it's hard to know exactly how they're going to react until they get a couple of years of new data to work on.
Kevin, is it something where maybe the young guard, and please correct me, I'm not being disrespectful, but not perhaps understanding the nuance of that, not understanding the nuance of what folks did 15, 20 years ago when they did not have this technology at their disposal?
You know, I think it's a new paradigm shift, right? So with all this technology, there's new devices out there, there's new futures, contracts. I mean, we're seeing the flash crash that happened actually in the equity markets was due to the E-mini futures, right? And so now we're still pursuing that avenue and going back to quote stuffing with the HFTs and what have you. So we're looking for the regulatory environment to come in, but there are mechanisms, right? The market, the New York Stock Exchange can close, as well as we're going to see Yeah, sorry.
No, I was going to say, it's not a question of the young guard not being prepared. It's just a question of how will the young guard respond when the Fed does raise interest rates. You have all the information you need.
We do have all the
information. And the Fed's been telegraphing this for however long.
Yeah, it should be slow and moderate, right? So we saw Janet Yellen even talk about asset inflation when she recently commented about how stocks and bonds may be overpriced. So they're telegraphing that the Fed is very conscientious of valuations that are in the marketplace as well as liquidity. So they're trying to telegraph to the street that it should be gradual. If you look at the Fed funds future rate out to the end of 2016, it's indicating less than 1% move. So the market's not really anticipating, and the Fed's in a Goldilocks situation where job numbers are down, but the economic data is, slowing, so they can actually do that slow tapered move.
Then Michael McKee, since I have you up here just quickly, saw that Janet Yellen will not be going to Jackson Hole. Is that a big deal?
We don't know why. Her schedule's pretty packed, and she's got a lot of international travel around that time, but she also has the Fed meeting at which a lot of people think they will move 2 weeks after that, and maybe she doesn't want to be out in public with people expecting her to say something about it with all that media focus.